Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
And this goes to a point, Steve, let me just add this commentary, which drives us crazy. Everybody says, well, the debt to GDP in the U.S. is soaring, so there has to be inflation. Well, there doesn't have to be inflation. The best example is Japan. The debt to GDP in Japan is over 200%, but they're in the worst deflation they've been in. So it's not always about debt to GDP, that determines the inflation rate. It's money getting into the real economy, and the people in the real economy bidding up prices for goods is what creates inflation, and we're just not seeing that, and because of low capacity growth, we don't expect to see it.
Great point. I mean, I've talked to a couple people that said that their view is commercial real estate here in the U.S. is looking even weaker and weaker each and every month. So we'll see how this all plays out, but I guess that's back to your point, Jack, that there does not have to be inflation just because we have higher debt levels relative to GDP.
Right.
A question, Jack. When would you change your mind? And I guess we always get this question because people know that you are very optimistic on the dollar relative to the other currencies. What would really be a game changer for you that would make you say, boy, oh boy, I'm done with the U.S. dollar for whatever reason?
Yeah, it's something we talked about in our service about a week ago. And as I said, it's something that has us very concerned about our story, to be perfectly honest. And it's part of what we do. We try and find reasons our story is in trouble. And our story is in trouble. Not enough for us to change yet. But here's where it weakens in a very, very big way. When you go look at that, if I can page back to that current account deficit again, from a global macro standpoint, it's an interesting concept here, especially in the world of trying to rebalance the global economy. But if you notice this movement back down, deterioration in the U.S. current account, if the U.S. policymakers realize that what they've done is not working at all and they have no bullets left in the gun, the remaining policy left for them again is for the Fed to then announce quantitative easing. When the Fed announced quantitative easing in March of 2009, the dollar just fell off a cliff. If they announce quantitative easing, it'll also be an acquiescence that the U.S. is probably going to allow China to continue to run massive trade surpluses against the U.S., where there was a lot of noise being made from all these senators, about China trade. You may have noticed that China had another big trade surplus against the U.S., but the senators were pretty quiet. And here's the problem in the global economy and why we think this may be the policy, and if it is the policy, it could be lights out again for the dollar. Germany has to export, and they have to have somebody to take them. Japan needs to export, and somebody has to take it. China needs to export, and somebody has to take it. Who is left to take it? There's nobody buying in Europe anymore. China doesn't have the depth of the domestic market to take those exports. Japan's consumer is still just tagging along. The U.S. has to take those exports. And if the U.S. policymakers say that the U.S. is going to take those exports, let its current account deficit deteriorate again in order to maintain liquidity in the global economy, and the Fed goes into quantitative easing, our story probably just is annihilated with that. So we're watching how the Fed acts or talks about quantitative easing, and we're going to watch one more quarter of this current account and just see how these politicians are reacting to the Chinese trade surplus. And they've been very, very muted given the last one, which surprised us a bit. So that's where our story falls apart.
So, Jack, what would happen to bonds then? If we're going to be sort of printing money, endless amounts of money, wouldn't bonds sort of turn the other way and people would be scared of them, government bonds?
We don't think so. I think you have the same situation. I mean, what's interesting, if you were to put up a money supply chart,
right,
or just a monetary base chart, not money supply, but monetary base chart, and overlay an interest rate chart on that, monetary base has gone straight up. We've printed money as fast as we can. but interest rates have gone down, down, down. So again, it's not that simple. Just because the U.S. wants to use the dollar as tissue paper again for the global economy, it doesn't necessarily mean they'll abandon the bonds. In fact, what you may see happen, if the U.S. actually uses the dollar as tissue paper again, you're back into this situation here.
Way.
Right? And what happened here? You had China recycling all that global capital back into the U.S. economy. So if we get back into that game and they try and regenerate that symbiotic relationship, of China surpluses coming back in, all that money pouring back into the U.S. capital markets will tend to keep U.S. interest rates suppressed because they'll keep buying those bonds.
Right. Sort of a quid pro quo for the Chinese.
Exactly. Yep.
Andrew has a question about how will China prevent a collapse in real estate prices there?
They can just turn on the monetary spigots again. In some ways they're tightening up, obviously, standards and raising down payment requirements and things like that, trying to cool it. But in another sense, their monetary policy sure is expanding slightly to take off some of it. They can just change policies overnight. That's the beauty of being China. You can just rock and roll, and say, okay, because the banks are nothing but conduits of the central committee, and you can just tell them, okay, start pumping money back into real estate and allow them to continue to build those off-balance sheet vehicles that the state and local governments have used to enrich themselves and use for real estate speculation. So they can turn it back on again. But what is an interesting point, and we made this recently, again, in one of our issues the other day, there were a lot of people, there's a lot of hot money pouring into China, and when it was pouring into China, it was sitting in real assets and real estate, expecting this change in the currency policy, a one-off change in currency policy, a real big revaluation. Well, the fact is they didn't get it, and this change in currency policy means just a very slight crawling peg. So China may be a little bit of a box because of the crawling peg. People now say, okay, we're not going to have a one-off revaluation. Our real assets aren't going to shoot up on a relative basis against the U.S. dollar. Prices are starting to fall. You may see a lot of hot money come pouring back out of China just on this small turn in prices and the change in currency policy, and that's something else we're watching.
Couple more questions, Jack. That's a great point. Chip makes the point that if you're wrong and the dollar does start to weaken, obviously, well, his point is that the euro will probably rally, and then the value. Well, let me just read. But if your story falls apart, then the euro will rise in value, and their products become more expensive. Then what? It's not necessarily the case, is it, Jack? Just because the dollar sells off, the euro doesn't necessarily have to rally, does it?
No, but I take his point, and I think his point makes a lot of sense. Because the euro, despite its warts and all, really is the other major global currency competitor in terms of depth. A fall in the dollar, just by virtue, you're going to tend to see a money flowing into the euro, a rise in the euro. But if I read what he's saying, it kind of creates its own destruction, a rising euro in here. With austerity coming across all of Europe and a rising Europe, it puts even more and more pressure on them. So ultimately, it has a certain amount of breaks for the euro itself, and it changes the cycle again. Because if the euro were to really appreciate, you would see again Germany, the pressure on German trade, and you'd see Spain and the rest of those people just screaming because they would have no chance to access the export markets. They're already having to compete against Germany with the same currency. If they got more and more pressure from a rising currency in the midst of this austerity, it would lead, I think, to even more social unrest. So it kind of creates the seeds of its own its own destruction with a rising euro if the dollar starts to fall apart, which begs the question: then where does the money go?
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.